We're not doomed. There are ways to invest in adaptation. 2 years ago, a grid freeze paralyzed Texas and sickened tens of thousands of people in the state. Last summer, wildfires in the US and Canada destroyed huge tracts of forest, made many more thousands of people ill. Around the world, calamities like these, or river flooding in China, or extreme heat in India, or drought in Sudan make it clear that humanity is in for more sea rise, more extreme heat, more wildfire, more drought. Of course, we need more solar, more wind, more efficiency, more credits, more offsets, more batteries, but that's not enough. It looks like all these things will happen anyway. So businesses, governments, global societies will have to make hard choices about which assets and which people to protect, or to move, or to abandon. Is hope lost? Well, of course hope is not lost, not at all. We have new tools that were never available before to help us with these choices. Just 3 categories of these tools, which I'll talk about, include new sensors, new powerful analytics, and new capabilities to project the likelihood or unlikelihood of extreme weather events by place and by peril many years out. Who will pay? Well, there might be not enough money or not enough political consensus within government to help us all invest ahead against these threats, but there is plenty of private money in the global financial system, and there are compelling co-benefits to investing in adaptation now. How do we attract that capital to the cause? I'm John Macomber. I spent most of my career in real estate and construction. I like dirt, concrete, and cash flow. Now I'm a finance professor at Harvard Business School. I studied the private finance and delivery of public infrastructure, like power, water, roads, bridges, and rail. I'm also the faculty chair of our Africa Research Center, looking at the growth of cities, the challenges of climate and urbanization on that continent. So what's the big idea? First, consider that there is defense and there is offense, not in the case of the New England Patriots anymore, but homeowners, businesses, and even cities need to select which perils matter right now, which interventions have best benefit per cost to protect them from, say, flooding. That's defense. One can also play offense. Using the same tools, you can ask where are there inventions and investments and innovations that create new value in the face of these shared perils, that create new value. Second, let's look at new tools. One of them are forward-looking projections that look at risk times readiness over time. None of this existed 5 or 6 years ago. What does this mean? So imagine a simple home in the Philippines where there might be perils including flood, fire, sea risk, and seismic. In the past, the homeowner might not know which risk she was most exposed to and might also not know how to best harden the house against that particular risk. Now there are multiple public risk match projections looking at all these perils down to the parcel level. Today, your insurance company actually knows more about the ground your house sits on than you do. This is an information asymmetry that you as citizens ought to be thinking about. It's also now possible to gauge readiness. How ready is your structure? Looking at risk times readiness, the Philippine homeowner can determine where best to invest to improve that equation. Her readiness can be improved. What the IFC group of the World Bank is working on here is a simple way to say, here's the cost-benefit analysis for strengthening your house based on the risks that you see, and we can improve this and be able to invest. So what about the upfront money, you think? Indeed, if citizens start to make economic decisions about their property based on these thoughtful risk times readiness measures, can the mortgage companies be far behind? Probably not. Lenders will lend more money to less exposed, more ready homes and campuses. They'll pull back from those which are more exposed. We're already seeing property insurance companies cherry-picking what assets they will cover, which ones they'll walk away from. Capital markets who play offense when choosing where to invest, you can play offense too. But isn't this immensely unfair? Well, yeah, it's really unfair. And what I've described so far, people like us in the room with access to good information, access to capital, will be just fine. Thank you very much. People with little access to capital or who are being misinformed or even being lied to about the risk of flooding or wildfire or drought will be even worse off than before. Not only is this immoral, it's also bad business. Well, why is it bad business? It's bad business because coldly, it's super expensive to society to make up for destroyed homes and for climate-related pulmonary and cardiovascular perils that sicken millions of people. It's more effective to invest upfront in adaptation measures where the risk and readiness are incorporating not just the direct dangers to the structures, but also the indirect damage to human well-being and to public health. That's how to select where to invest from an investor point of view. Investors don't like uncertainty. You can get paralyzed by uncertainty. We don't really know what weather might occur. We don't know in a specific year. It might be a hot summer, it might be a cold summer. But actually, we have a very good sense of the probabilities of occurrences of outlier events, whether in the stock market or in the weather. The best models also share the probabilities of events as they change over time, or the likelihood that a big event happens, or more likely, a big event doesn't happen. Like, we don't want to invest in resilience for an event that won't happen. So decisions about offense and defense and risk and readiness can be made with the benefits and costs weighted against the probabilities and likely impacts. It's MIT, so I don't have to explain to you what it means that this curve moves to the right and flatter. It means more variability, more volatility, and less reversion around the mean. This is for heat in Portland, Oregon. What else is new? Another tool that's new is high-quality sensors in the hands of individuals, measuring from seismicity to personal wearables to indoor air quality measurements to outdoor air quality tracking. 10 years ago, you needed an industrial hygienist to look at air quality. The hygienist would come in a suit and a coat and all this stuff and bring the beaker of air off to the lab, and the report would come back one point in time, one data point, owned by nobody, owned by the building manager. This is totally different. Now there are dozens of wearables like Fitbit or Apple Watch or Whoop, and scores of air quality monitors, all sending real-time information to the open data cloud so that individuals can access and act on data that's more granular, more current, and more open than what even the local government can provide. The data is in the hands of citizens. Citizens are talking to each other about the plumes of wildfire smoke or the condition of their condominium. Totally flips the negotiating power from the landlords and the banks to the individual citizens. This is new. Finally, of course, there are new analytics. We've talked about this quite a bit. They were never available at scale until a few years ago. Many speakers have discussed machine learning, predictive analytics, generative AI. Almost anyone can parse this data. If people are complaining about the status of their office building or their condominium or their apartment on Glassdoor, this can be scraped by academics. These academics at Northwestern, not at MIT, but it could be done here as well. You can create a shared pool of evaluations like Glassdoor or OpenTable for where to look, where to live, where to hang out. So back to the USA and Europe. A condo buyer can now be equipped to filter properties not just by access to transit and quality of local schools, the usual stuff, but also with objective analysis about the real threat or lack of threat of damage from fire or flood, or even destruction in a weather event, or thinking about the health of the building in terms of the air quality outside and inside. Obviously, mortgage companies have this information too, if you have it as a homeowner. So more money will flow to where there's less perceived risk and more perceived readiness. So as Buckminster Fuller was thought to have said, work with forces, not against them. That's what I try and think about, is how we work with these forces of capital, of measurement, of risk, of readiness to get to good outcomes for all of us. So what's the big idea? The idea is really in four pieces. One is investing in adaptation is a huge opportunity when you consider risk and readiness. You can impact both risk and readiness with what you physically do. The second, you think situation by situation. You know, Turkey is not Oregon, it's not Sudan, it's not Miami. Use weather models with likelihoods. These probabilities are useful. We don't know what's going to happen, but we can have at least an informed idea, just like we do about interest rates or the stock market. And use these new sensing tools with analytical techniques that has the data in the hands of the people. So I'm kind of dating myself by quoting an old movie, but follow the money is still really good advice, particularly if you think about the motivation of mortgage companies and insurance companies who will influence how you live, and think about the kind of entrepreneurial opportunities to harness that data. Well, right now, we're all going out individually without this information, without this knowledge. We can all work together to optimize what we do going forward, to think how to invest to create a better future for all of us. That's my hope for all of us today, and thank you for listening to me.